Now let's look at the third structural shift today, and that's globalization and the evolution of containerized shipping and the impact that that is having on sea-based logistics. So we've all seen these big boxes that are on the back of trains or in the ships. And this is, you can call it a box or a container, or the technical term is a TEU, which stands for 20-foot equivalent. But whatever you want to call it, this box has really changed the world, especially with regards to globalization. Now, containerization, the idea of it was the brainchild of an entrepreneur named Malcolm McLean. He was an entrepreneur and an East Coast trucking magnate. He believed that if you package goods in standardized containers, it would save money and time by being able to move it from a truck to a ship back to a truck again. And in 1956, he tested this theory. He moved 58 containers from New Jersey to the port of Houston on a retrofitted World War II tanker. At that time, loading and unloading was done by hand, and often the ships spent more time in the ports than they did at sea, so he had a vested interest in seeing this work. Well, on that maiden voyage, McLean's theory proved out. He reduced loading costs from $5.83 a ton to 16 cents a ton. With that stroke of genius, global logistics was forever changed. And at that time, the writing was on the wall for those that were looking, especially for Freddie Fields, who was the head of the Longshoremen's Association. That's the union that's responsible for the loading and the unloading of these ships. Well, when he was asked what he thought of McLean's new container ship, he said, well, I'd like to sink the son of a bitch. And did he try? He and the entire industry tried through years of lawsuits and countless strikes. But even though they tried, 10 years later, McLean, after the introduction of McLean's container ship, the world internationally adopted it. And as you can see in this chart, along with that adoption, global growth grew dramatically. Here we're looking at a chart of world merchandise trade. And from 1966 to 1983, the number of container ports grew from 1% to 90%. And this dramatically expanded global growth. For the 35-year period from 1966 to 2000, that's the year just before China entered the World Trade Organization, global trade increased 7 times. And after China was in the World Trade Organization, global growth increased 2.5 times. So you can imagine, with this kind of growth, the shipping companies had to respond. This next chart, we look at the evolution of container ships. In the early days of container ships, the largest available ship could hold 500 to 800 of those containers, or TEUs. By 2000, just as China was entering the World Trade Organization, the largest available ship at that time was 8,000 TEUs. Just recently, the shipping company Maersk unveiled an 18,000 TEU ship. This increase in capacity is driven by 2 primary factors. First was the need for the shipping companies to respond to the pure volume and the demand volume because of the growth. And secondarily, because the economies of scale in the shipping industry dictate bigger ships because it lowers operating costs. Now, up until recently, this evolution to bigger and bigger ships was really constrained by the desire and the ability of the shipping companies to fund the increased ships, as well as the shipyards, the technical ability to build the ships. But now, geography is starting to play a role. Beginning in 1996, the largest available ship at that time was too big to pass through the Panama Canal. So in response, the Panama Canal authorities drew up a plan to expand, widen, and deepen, and add a 3rd set of locks to the canal. This expansion is set to be complete in 2014. But with the evolution towards bigger ships, that Maersk 18,000 TEU ship is once again showing that the largest available ship won't pass through the canal. Again, geography is playing a significant role, and it is impacting shipping routes. Now, to put this size of this 18,000 TEU ship into perspective, take a look at this. It is about the size of an Empire State Building. Now, looked at it from another way, if all 18,000 of those containers were filled with tennis shoes, it would hold 111 million pairs of shoes. That's enough to put on the feet of every citizen in Mexico. That's just one ship. But it's not stopping there. Soon there'll be a 22,000 TEU ship. Why 22,000? Not because it's a round number, but because that's the current geographical limits of the Suez Canal. So, as shippers continue to push for bigger and bigger ships to meet the demand and to lower their costs, it continues to put severe stress on the sea-based logistics infrastructure. Which brings us to our next theme, which is the widening and the deepening of the Panama Canal and the impact that that is having on U.S. ports. So as bigger ships are passing through the canal, these ports have to and we'll see substantial upgrades. They need to deepen and widen their ports in order to accommodate these bigger ships. There's currently $3.6 billion set to be spent over the next 4 to 5 years in order to deepen and widen these ports. That is 2 to 3 times larger than the average spend for deepening. Now, we're using a bit more conservative estimates. We think it's going to take a bit longer than the 4 to 5 years. But nonetheless, when we combine this deep porting that's happening, plus the normal maintenance work that is required for seaports, along with the maintenance that is needed up and down the Mississippi River, plus the marine construction work that needs to be done because of the chemical build-out, plus the marine construction work that needs to be done because of the LNG terminal work, we see an industry that is going to be far short of the assets required to service all this, which means it's going to be a tight market. We'll see higher revenues, higher income, and higher asset prices. To capitalize on this, we've bought 2 port dredging companies, Orion Marine and Great Lakes. And we have another group, top secret, which we are not about to say, because we see this as a substantial opportunity. When we do buy those, you'll see them in your portfolio. Now we look at the second phase of this structural shift, and that relates to the overall impact that this is having on logistics. As these bigger ships pass through the Panama Canal, it changes the economics of shipping, and it's certainly altering the industry, and it's going to produce new winners and new losers. This map represents the economics of a 4,000 TEU ship, which is roughly the average size of a ship that passes through the Panama Canal today. This black line represents the break-even line. In other words, for those areas that's left of the black line, it is cheaper to ship to and from the West Coast. But for those areas that are right of the black line, it's cheaper to ship to and from the East Coast. That 46% number represents the population density to the right of that black line. As we look at what happens when an 8,000 TEU ship passes through the Panama Canal, we see these economics change dramatically. You see the black break-even line? It will mean 63% of the population will have a cost advantage from shipping to and from the East Coast. This shift towards the larger population density and manufacturing centers will certainly shift the decision-making of logistics companies and shippers. And this is going to have a wide range of impacts from distribution centers, warehousing, truck, rail, as well as many other industries. But there's still too many variables that are yet to be determined for us to definitively say who the winners and losers are. But we are certainly tracking this because we see it as a great opportunity. As we have more clarity and as we find those opportunities, we'll certainly be adding stocks to the portfolio to benefit from that.